You should now see the first of my slides. Needless to say, I was a bit surprised myself. When I put together the slides for today's presentation, I went back to the presentation I gave after the August reporting season last year. And to my surprise, there were a lot of things we still have in common today. And we're 6 months down the track. Conclusion number one. However, we want to call this process that has started in early 2022 and is still ongoing. It's been glacial, it's been gradual, it's been slow, and it's still ongoing. My presentation last year was titled Patience, Please. And you can see from today's title, it says, are we there yet? For those who may not have a lot of patience, the answer is no. So if that's all you wanted to know about today, then thank you for coming. And for all the other ones, I will try to keep this within the next hour. And hopefully I'll be successful at that and a few more things. You know the drill. If anything I say today can be construed as financial advice, it means you have misunderstood me. But I do hope that by sharing some of my analysis and my insights, that I will give you enough positive input that you can use to your own benefit in many ways for the months and years ahead. I'll try to take you out of finance for the time being, just for this particular moment, and just assume that we didn't know what we know now by observing the financial markets over the past 15 months or so. And we're living on a tropical island, isolated from just about anyone else. And we have the surfboards ready, the bananas are growing on the trees, and the only link we have with the world is a radio. And the radio gives us some news. And let's just assume for the time being that news is that bond yields are surging from record low levels to much higher levels. We have the outbreak of inflation to levels we haven't seen in many decades. In some countries, it actually goes into the double-digit percentages. Central bankers respond by going on the fastest tightening pace we have ever witnessed. And in particular, or if we consider the relative pace that has been going on from basically from zero. The starting point also occurs when asset valuations are very high, in particular for the three main assets that we usually pay attention to: real estate, bonds, and equities. We have corporate profit margins at historically very high levels, record highs in the United States. And all this happens in a world that is carrying as much debt as it ever has. And I'm sure that every one of us would agree that if we were on our little islands, we would probably not have guessed that the local index is near an all-time high in April 2023. It shows you that how difficult it is to make forecasts for financial markets. It probably also shows you that there's always room for surprise in financial markets, and I can speak for the majority of investors and of experts that they would not have expected the market to be here right now, and it is basically back in an uptrend over the past week or so. It also can serve as an indication that even though shares have fallen, volatility has been high, markets have gone through the ringer at times, they've been lower, they've been higher. But in a broader context, I think the big surprise that we have seen over the past 15 months or so is that, all else being equal, markets have been relatively resilient. And that is conclusion number one. It's also surprise number one. And we might try to look into that as to why exactly is that, because on the basis of the news that the radio brought us on a little island, I'm pretty certain we would have expected that markets would be a lot lower than where they are today. And one of the positive angles that we can take, of course, is that markets are always forward-looking. That's the official line, and that's the official line that the optimists in today's market will put to us. And on the left-hand side here, I have an historical chart which I'm happy to use from Janus Henderson's. And without putting too much emphasis on this chart, but what this chart actually shows is that valuations usually trough. They bottom before earnings do, and that is basically the market looking forward. So the market anticipates that bottom in earnings growth is happening and is approaching, and from that moment onwards, valuations no longer fall; they start rising. That's one side of the story, and that is one potential explanation. The other one is on the right-hand side. There's quite a few, more than a few. There's quite a number of market experts around who simply believe that markets are complacent here, too expensive, ignoring the fact that there's more bad news coming. And I've added 2 quotes from strategists that believe that is the case. And that is the conundrum that investors at this point are battling with. Do I go all in because a new bull market has started? We're looking forward. Am I a little bit more patient because there's definitely more volatility and more bad news forthcoming? For what it's worth, I'm more on the cautious side here still, because I am pretty convinced that we will see more bad news, but there's never a guarantee in life, and definitely not in financial markets. Going a little bit technical now, but I thought this is a perfect way to illustrate why markets have surprised with their resilience over the past year or so. And the experts, the industry, they talk about the ERP, and that is the equity risk premium. And it's basically the risk, the valuation that investors are prepared to put on equities in comparison to the bond market. And usually what happens is that when you go during times of stress and duress, then basically the equity risk premium goes up, and then equity valuations go down. And if that had happened, like it always usually does in history, then equity markets would have easily done another 15% or so to the downside. And the fact that it has not happened is predominantly the reason that a lot of those dire forecasts, they've not come to fruition. You can see here that equity risk premium is much lower than where it usually is. It has gone up a little bit, not that much though, and it still remains in a zone where it usually isn't. Now, there's 2 angles we can take here. If we assume that the risk premium goes back to where it historically was and has been, then yes, equities can easily have another 10-15% downside here. And this is also one of the reasons why part of the investment community is quite hesitant to go all in at the moment. But obviously the problem is that while we can all form theories and speculate, we actually don't really know why it hasn't happened, and why equities have remained quite resilient, and why that premium just doesn't want to go back to where it was. So the problem with, if we don't know why it has happened, it's also very difficult to forecast when it will change, and even whether it will change or why. So this is, for the time being, I guess, the uncertainty we just have to live with, and we just have to carry, and just have to wait and see what happens. Another way of looking at the markets, and I thought this was quite a revealing chart that I found, is that if you divide the market into 2 roughly opposing types of stocks in the market, one is growth, one is value. The growth stocks are traditionally on higher multiples, the value stocks are traditionally on lower multiples. Then you see that big gap between those 2 has basically persisted as well. And that too has been, at least for the value investors, has been a big surprise as well. They would have forecast that the top part here, the dark green, which is the growth part of the market, that would have fallen a lot more. It has fallen, as you can see here, but basically it has not closed the gap with the value part of the market. Now, again, you can now have two different angles here. Either that still has to happen, or this is just similar with equity risk premium. This is just a new situation we have to work off from. The irony here is, of course, that lower PE ratios for the value part, in particular when it amounts to resources companies, is not necessarily bad news. It just means that they are going through peak conditions, which means you get lower valuations. But the other part, of course, also is that if we are going through tougher economic times, and I would argue that a lot of indicators and signals are pointing towards that the lower part here, the light green, the value part, that's the part that should feel it the most. And that's why you can't easily anticipate that the top part here will just join the light green part at some stage. It may well be that the light green part is not as resilient as the top part in tougher economic times. In very simplistic terms, of course, in the US, the dark green, the growth part, would be represented by the big technology companies. In Australia, it would be the likes of REA Group, Car Sales, and CSL, Technology One, for example. The bottom part, of course, that would be your traditional banks and resources companies. Another interesting chart to point out here, and this is, even though a lot of changes have gone quite gradual and slowly paced between last year and this year, one major change, which is definitely making a big impact this year, and definitely in the outlook that analysts are now foreseeing for sectors in the market, is the interplay between hikes by central banks and bond yields. And I have been saying since late last year, and I think the future will prove me correct in this, that bond yields have peaked now. And that might seem like a strange prediction to make, given that central banks are still in a tightening phase. I mean, today, the central bank in Australia, the Reserve Bank, has decided not to increase the cash rate after 10 increases. But they've also sort of suggested that this may not necessarily be the end of the story. Similar things are happening in the United States. They haven't paused yet, but they are continuing to communicate to the market that they may not be finished yet. Now, while central bankers may not be finished yet, they are approaching the end of the tightening cycle, whether that is next month or the month afterwards or in the second half. It won't go on forever and ever. But the other thing is that the bond market, they are forward-looking as well. And what you can clearly see here with every tightening cycle, in very simplistic terms, the darker line, those are the yields on government bonds. The yellowy lighter line, that is the cash rate in the United States, the federal funds rate. So what you see is that bond yields peak well before the cash rate does, every single time. That's because at first, bonds anticipate approximately how high tightening will go. Then subsequently, they start anticipating the consequences of that tightening. And that is usually a much slower economic activity in economies and potentially a recession. This time around, we have seen the same. The bond yields have already moved up well before the Federal Reserve started tightening. From the moment they started tightening, bond yields moved a lot above it. But right now, it's already going downwards while the Federal Reserve is still tightening. The consequence of this is that we see coming back into favor in the market those sectors that previously have been heavily damaged by bond yields moving up. The most obvious ones to mention here are the long duration, the growth stocks. This is not necessarily the case for real estate trusts, but we will talk about that a little bit further in this presentation. No tightening, without consequences. And of course, the world has been keeping a close eye on what was it that it was going to break this time. We saw a lot of the speculative ends in share markets being absolutely clobbered. We saw the crypto space going through, I would say, some serious damage and some serious crisis left, right, and center. And ultimately, we saw a new banking crisis emerging in the United States. It had a very brief expansion into Europe that was quickly backstopped by the Swiss. And for the time being, markets are pretty relaxed because it would appear that worst case scenarios are not yet coming to fruition. Yet, history shows that these banking crises, they have longer to run. And there will be consequences. The most logical consequence is that if previously some people might have doubted that the United States would have an economic recession this year, then the odds for that recession have obviously have tightened now. The chances have increased that we will have an economic recession simply because you get the fallout from the regional banks in the United States. The big element that everyone is keeping an eye on now is commercial property. That will probably be the focal point of the next crisis that will be building now. There will be probably a fallout coming to Australia from that as well. But at this point in time, we have no idea when exactly, how exactly, and to what severity that will happen. But everyone is focused on it. If you really want to investigate what is happening in the US banking sector, and the most logical, the most obvious comparison to make is with the savings and loans crisis of the 1980s and 90s. A lot of commonalities. Dr. Google can help you with that. In the present term, these two charts here show you exactly what has happened in the United States. On the left-hand side, we see that there has been a flight of deposits, basically, by uninsured depositors in the United States, a very logical response from them. On the right-hand side, we see that because banks hold government bonds, that they need to hold a certain percentage as a so-called safe asset. But if the Reserve Bank goes on a tightening spree, those assets will cause losses, at least on paper. If you have one in combination with the other one, you can potentially go out of business as a bank. And that, of course, is exactly what has happened in recent times, at least for those banks who were not well positioned or didn't have their risk management in order. Another reason, and equally valid as to why equity markets have remained relatively resilient up to now, is liquidity. And central banks have discovered that they can not fix everything, but they can fix a lot by injecting excess liquidity in the global financial system. Now, previously, that was done through quantitative easing. Central bankers do not want to go on quantitative easing forever and ever. So they found new ways of doing it. It's not called QE this time, but it's still injecting excess liquidity into the system. And traditionally, we tend to measure corporate profits, we tend to measure economic growth. We don't really have a lot of measurements to measure liquidity. I mean, there's a few sophisticated investors out there who have their own models and their own indicators, but there's only very few that are experienced and sophisticated enough to do this. For the majority of us, we can only guess. But there is one measurement that many people look at, and that is basically cryptocurrencies or Bitcoin. And why is that? Is that recent history has shown that Bitcoin it acts on liquidity in the market. And you can clearly see that on this chart here, that when liquidity was abundant, everyone was into Bitcoin. And when the reserve banks around the world, the central bankers started withdrawing liquidity, a lot of people lost a lot of money. In recent times, and that is by no means a coincidence, on the assumption that Bitcoin retains its role as a measurement of global liquidity. It started moving up quite significantly in January, and that's exactly when global equity markets started rallying as well. You can see in April, in recent times, it has gone up again. And so if that connection with liquidity remains, then Bitcoin might be our best weather vane to see whether central bankers are keeping the liquidity up in markets or not. Definitely something to keep an eye out for in the future. Now, if you combine all of that, and point one to make is that these are not my views, but as the editor of FN Arena, I see a lot of research passing my desk, and I've used the input from global asset managers and fund managers and strategists to give you an idea of what is in and what is out, what is favored, what is not favored. The thumbs up and the thumbs down for several segments of the market in the United States. And point one to make is that many investors, experts, are still a little bit uncomfortable with the valuations that are still in place in the US markets. Many portfolios or recommendations are to go underweight US equities. In their place often are either European assets because they are cheaper, or emerging markets because they are performing much better on the economic growth. The other very important element to point out is that after the big reset we had last year, bonds are back for portfolios. They're no longer extremely highly valued with extremely low implied yields. These days, bonds are back to counter the risk that are with equities, and a lot of fund managers are taking bonds back in. Now, there are a few things to point out when we see the sectors which are in favor, the thumbs up one. The market is still very much in favor of the energy sector, the best performing last year by a mile. And even though that superiority this year might not be to the similar extent, you would hope not, it's still very much in favor. In the US, people are choosing healthcare as an offset for the potential recession that is coming. And if not a recession, then at the very least an earnings recession. Healthcare in the United States is also seen as a very solid and defensive sector. As I pointed out earlier, technology is back, in particular if you're big and profitable and generate a lot of cash, because bond yields have peaked, and that's also something that is on the agenda in the United States. There is a widespread expectation that the major indices this year in the United States will not achieve much. So either we go down or we stay into a trading range. If you go sideways, then all of a sudden the emphasis lies on dividends and of high quality. And high quality, that means that those companies, they are very unlikely having to issue a profit warning or have to cut their dividends essentially. So as defensives, including staples in the United States, are usually well represented in portfolios. The material sector has never gone out of favor, but there is an emphasis on the critical materials side. Think cobalt, think lithium, think copper, maybe even zinc and nickel and the likes. And this year has seen the return of gold. Very much out of favor in last year, predominantly because the bond market wasn't playing ball. On the assumption that bond yields have peaked, gold is back in favor, and of course, a good old-fashioned banking crisis in the United States, always good for gold. On the other side, as I pointed out, real estate trusts, very cautious. They carry a lot of debt that has to be refinanced. So all eyes on commercial real estate. They also have a lot of leverage to offices, to consumer spending, to the housing market in general. Hence, it's been seen as a thumbs down sector. Small caps, It's good to point out, I am talking in generalized terms here, but small caps have significantly underperformed their larger stocks ever since we went through this process. That means a lot of people are still very skeptical. In particular, if we will have tougher economic times ahead of us, smaller companies cannot deal with that to the same extent as larger companies. And no surprise, financials are out, and everything that is basically related to housing markets and to consumer spending, because those are the things that come under pressure when bond yields stay high, inflation is high, and all that support from COVID is falling away. Now, in Australia, because that was the United States, in Australia, we have a slightly different situation. We don't have big tech, but we also, on most forecasts, are going to avoid a recession. We will, however, have economic slowdown, which, depending on one's view, is less severe or is better placed, but it's still slowing down, of course. But the big element that we're battling with in Australia is called the mortgage cliff. And even on the RBA's own admission, own assessment, less than half of all the rate increases that have happened over the past 10 sessions have only by now been passed on to Australians that carry a mortgage, both fixed interest and variable. That means, of course, that even if the RBA would stop hiking from here onwards, there's still 50% of those increases still have to be passed on, and that effect somehow will impact. The mortgage cliff is only now starting to unfold. You can see on this chart the percentage of fixed interest mortgages that has been fixed and is maturing this year is only now this month starting to really pick up, and in the months ahead it really picks up, and it stays relatively high for the rest of the year in comparison to what we've seen so far. Have Australians all done the right thing? Have they all taken out a mortgage that was well within their means, and they've all have had plenty of time to prepare? And even with inflation, we will all find out over the months ahead. Needless to say, there's plenty of anecdotal evidence that even without this cliff unfolding, the higher interest rates in Australia have started to impact consumer spending and businesses. Builders are going bankrupt. Even the banks are noticing that the amount of people who have difficulties in paying off their mortgage is increasing. And you would expect that it won't be far off before we see a more pronounced impacts on consumer spending as well. This is obviously the big question mark that hangs in front of Australian investors now. Now, if you look in terms of what are the sectors in Australia then that are in favor and out of favor, they differ a little bit from the United States. Probably the most important thing to point out here is that banks have swiftly moved to the thumbs down part of the market. Most professionals have by now moved underweight banks, if not completely out of banks. And in their place, the favor has gone to insurance companies and to diversified financials. We will later on see insurance companies, they are still carried by the positive of the cycle that still works in their favor. In the most preferred insurance company in Australia is QBE. At a distance, it's Suncorp. The laggard is IAG. But you should also include the ASX-listed insurance brokers, which are equally riding this cycle. And you have to think of companies like Steadfast Group, Ausbrokers, and there's a few smaller ones as well. Diversified financials, think Computershare, think Challenger, think the fund managers like Magellan, Perpetual, Janus Henderson. Also include Netwealth Group and Hub24, for example, even though both there's discussion going on in the market right now in how much their inflows are being impacted by the fact that markets basically are in a sideways pattern. Technology, not too dissimilar from the United States. We don't have big tech, but we do have quality tech that is profitable and growing very fast. If you pay attention, like I do, and you own some of those companies, you would have noticed that Technology One, Pro Medicus, WiseTech Global, Altium, those companies have those share prices have performed very well over the past year when the rest of the sector was sold down and the markets in general went through a lot of volatility. Equally, if the market goes through a tougher time, and potentially it will, the emphasis shifts to dividends and high quality companies in the market. Dividends, I don't think we need to explain any further. High quality in Australia means healthcare. Gold and materials are here also in factor, and you will find that equally small caps and real estate trusts are being looked at in a much less bullish manner. In general terms, there's always exceptions, of course, but in general terms, investors at this point in time are very hesitant to go full in on those parts of the market. Now, harking back to last year and to my earlier observation that the process thus far has been quite slow and glacial based. Ultimately, the view is that everything that happens, all the outcomes ultimately in the share market, all relates back to corporate profits, which is true, although that's not always very obvious on a day-to-day basis. But when I look back in my presentation from last year, these were the major conclusions from the August reporting season. I've made an update for the February one, and to my surprise, the majority is still in place, but I've made it easier for you as a viewer and for me as a presenter to point out the differences here in highlight yellow. Where last year in August, most companies were quite cautious on their forecasts, but in their performance, they overwhelmingly beat forecasts and expectations. In February, that had completely disappeared. February proved one of the very few reporting seasons that we at F&O Arena have witnessed over the past decade and longer, where the percentage of companies missing forecasts was higher than the percentage of companies that still beat forecasts, and the beating part was not too high either. We also now have seen the creation of the so-called second half club, which, all else being equal in a slowing environment, should also create a lot more risk for what might happen in August. The second half club, just to explain to everyone, those are the companies that basically disappointed in February, but they stuck with their full year guidance. So they now have to have a good second half or a better second half to make up for the misses in the first half. And the reason why that increases risk is that the economy is not getting any better in comparison to the 6 months to December. So the chances that those companies have to admit that they will not make their guidance for the full year is obviously much higher now. What is a bit, what can be taken as a negative is that we always have a second half club on the share market, of course, but usually that's about 20-25% of the market. This time around, it's almost half. It's something around 47% or so, so it's almost half, which gives you an idea that equally things are getting tougher for corporate Australia, and it becomes increasingly more difficult for companies to actually meet expectations, even if that's their own forecast they put out in the first place. The major components are still persisting. It's cost inflation that companies are battling with. You still see there's more disappointments coming from smaller cap companies. If you are a technology company, you really have to be profitable now, or at least have a reasonable outlook to become profitable. Otherwise, you simply will not be on the radar of professional investors. One surprise is that certain sectors that are enjoying the benefits of the reopening of societies, they are still benefiting from that. And that is definitely also a surprise for the duration of which that happens. Think Qantas, we also think Hello World, Webjet, corporate travel and the likes. As I pointed out earlier, the energy sector, it still remains very high, highly regarded for portfolios, although its performance, outperformance, if there is an outperformance, will be definitely less superior this year. That's one forecast I can put my money on. And gold producers are back because we now also have a banking crisis. The peak in dividends has been pretty much confirmed, but it's not a fall off the cliff experience. And it's also not a across the board experience. Simple examples, BHP and Rio are expected to pay out less dividends from here onwards. Santos and Rio Tinto are still expected to keep on increasing their dividends, which gives you an idea. We're talking general averages here. There's always room for particular exceptions. As I pointed out earlier, discretionary retailers, everything that's related to housing, there's a lot of hesitance because of the mortgage cliff that we are experiencing. And forecasts, I said earlier that everything relates back to corporate earnings, but that's actually not true. Everything relates back to forecasts of corporate earnings in share markets, of course. And those forecasts, they are still falling both here and overseas. And that in itself obviously forms a headwind for equity markets. And it has been going on now for quite a while. Just a summary of the reporting season, but in a slightly more graphic way. I'm relying here on work done by Martin Curry. You can see here in reporting season that when it comes to sales and revenue, the surprise was to the upside. That's your inflation doing its work. But that same inflation meant that margins and profits disappointed to the downside. So we had sales surprising, disappointing on the profit side, basically. In the dividend side, the disappointment was much smaller. So dividends on a relative comparison again proved much more resilient than pure profits. That shouldn't be a surprise. In particular, in Australia, if a board thinks that they have to offer some compensation to shareholders, it's usually through an extra dividend or a higher dividend, or at least keep the dividend stable. Now, I mentioned it earlier, it's essentially all coming back to forecasts for corporate profits. In the United States, this is the situation. We are only 2 weeks away or so, approximately, from the US reporting season, which is quarterly. And in the first quarter, you'll see these are the averages. In general, there's more red and there's more double-digit red than most investors would probably like to see. Again, the trend has been downwards for US companies now for quite a while. The big question mark now is, are these forecasts now finally low enough or still not low enough? And how will the results actually come out? How will they impact the forecasts for the quarters that lay ahead of us? Because if this quarter turns out to be bad, but it's being perceived as the bottom of the cycle, then this might actually turn out to be positive news for US equities. If we look further at the very right, we see the forecasts for the full year, and they look a lot more beneficial. In many cases, you see that what looks negative in the first quarter might well end up either less negative or positive later in the year. And that's, of course, where the hopeful optimists are banking on. One thing to point out here, which immediately caught my eye, is consumer discretionary in the United States. It's actually showing up as really strong. That looks odd, but that's also, again, a reminder to investors that we're working with averages here, and it's always good to know what's in the basket, what's underneath the bonnet. And what you will find is that the consumer discretionary in the United States also includes the likes of Amazon, but also includes the car manufacturers, which means Tesla is in there. I would reckon that that has a major impact on those numbers. We don't have those companies in discretionary, so that's one of the big differences we have. The other thing to point out as well is that healthcare is not quite the same as healthcare here. Plus, what the US considers as small caps is quite mid cap over here. So there are differences. Maybe one thing to point out in the United States is that if everything comes to fruition, we will have quite a negative first quarter, and by year end, we're basically back to zero. Now, as an optimist, you think like we go from negative to zero, that's a positive. The skeptical ones will say, yes, but you're still at zero, and that means that today's share prices might be too high. Pick your pick. In Australia, as I said, we have a slightly different dynamic. We have forecasts that they're not high, but they're not exceptionally low either. Good to point out here is that the long-term average EPS growth for Australia is around 5.5%. What that means is that for this year, and again, forecasts are still falling, we're already below the long-term average. For 24, we are around that long-term average and probably due further falls. For 25, the expectations are very much below that. So if those forecasts fall further, which is the current trend, or they remain at current levels, that means Australia is looking forward to quite a number of years of below long-term average growth, which might again be on the back of RBA tightening, global tightening, slower growth, etc., etc. But we're looking towards a tougher environment for the market in general. Two things to point out here. In a market like Australia, those forecasts are very dependent on what happens in resources and in energy and mining. For the time being, you can tell that if we exclude resources, the numbers look higher. So clearly, the situation under the bonnet is not that bad for Australia. However, the dispersion is really, really large. I pointed at the financials earlier. You see that the financials have nothing to look forward to after a fantastic year this year. In particular, the banks stand out with a negative immediate outlook, of course. The same can be said of resources here. As a general forecast, there's really not much to be happy about. The same can be said of building materials here on the right-hand side and of retail. And you see that the big turnaround for the healthcare sector, which obviously up until now has been held back by the impact from COVID and from the lockdowns, that's unleashing a big growth revival over there. Insurance, I touched upon it earlier. The reason why it's back in favor and seen as a relative defensive exposure is that it comes obviously after a few bad years. It has tremendous growth this year, but still expected as a sector to grow very strongly beyond this year. Energy, a lot less to look forward to. And you see the same thing in the bulks, coal and iron ore, although diversified mining is still looking great. You do have high expectations for technology, for small caps, but we have to take into consideration that basically is an average between down by 100% and up by 200%, something along those lines. So it's an average for a sector, but you all have to take into consideration that the diversion behind those numbers is really, really wide and large and broad. A sector that I always feel inclined to spend some time on, and because nobody else does for starters, is the quality side of the market. It's not a specific sector, but I always take it as a specific element of the market, not well researched, not emphasized enough, in my view. Both globally as locally, I see a trend, and that trend was already prevalent last year, towards including more and more of quality stocks in portfolios, on the simple assumption that times will get tougher, and those quality stocks, they are essentially, they have a much lower chance that they will have to cut their dividends or issue a profit warning. And locally, those who are familiar with my research, it's no surprise. I mean, it's Technology One, it's car sales, it's REA Group, it's SEEK, it's CSL, it's ResMed, and a whole bunch of others. Promedicus, WiseTech Global. People always are very, very hesitant because these stocks trade on above average multiples, and overpaying for an asset it's a shame when it happens. But in the same respect, you can't expect quality to trade at very low PE multiples that we see, for example, for BlueScope Steel or for an Iluka. That's simply not how this works. The quality part of the market, equally important to point out, it has had a very tough time over the past 2.5-3 years or so, predominantly gone sideways, which to a lot of investors meant you don't want to be there. On a personal observation, I've never seen so many people predicting now that you should have CSL in your portfolio. I've been following CSL for at least 15 years. The number of people that now believe it's the time to have it in your portfolio, I've never seen that high a number. That might be an indication in itself. Now, I usually don't include financials or resources companies when I talk about the quality part, although, of course, every sector has higher quality and lower quality operators. But I recently published my analysis of the banking sector locally. And of course, the preeminent quality operator in Australia is CommBank, CBA. And long story short, you can access that assessment from myself with data and explanations as well. I will show you in a few minutes' time how you can do so. For now, I put the main conclusions of my research here right in front of you. And of course, the main conclusions ultimately are about investment return. And what you can clearly see on this overview is that the quality operator in the market, CBA, no matter when I pick my periods and divide them and put them together and add them and etc., there seems to be quite a very steady performance from CBA shares. And this is ex-dividend, but those dividends are more resilient than for all the others. And you see that is simply not the case with the other three, which I mean, ANZ and Westpac pretty much have had a lost decade. NAB has had a better recent years, but that was because the prior decade was that bad. It's a bit like the insurance companies. And you see the quality operator going steady as she goes just throughout the time. So while yes, the danger is that you overpay for CBA, the message here seems to be that you can only temporarily jump on cheaply priced alternatives because ultimately they will underperform the quality player in the sector. I think if I any time came up with an example of how quality exerts itself, I think it's right in front of you. Having said so, I maybe not so much suitable for this audience, but I do run an all-weather portfolio, always prepared to answer questions whenever there are any. And the research I just talked about why is CBA such a better operator than all the other banks, I usually put together a secret report in which I just curate a few of my stories from the past, which I think shine a different light on things in the share market. I updated it recently. That story isn't included. If you put /secret after the website URL, that report can be downloaded for free. And we've come to the end of today's presentation. I hope you liked it, and I'm ready to ask for questions.